Imagine a gleaming skyscraper in the heart of a financial metropolis. Suddenly, a tremor hits, maybe a bad inflation report or a sudden geopolitical conflict. The building shakes, but the steel foundation holds. The structure is perfectly sound. But down on the street, a disaster is unfolding. People feel the tremor, panic, and sprint for the exits all at once. The sheer, crushing physical force of millions of people running in the same direction shatters the glass and buckles the pillars. When the stock market drops, the destruction of your wealth is rarely caused by the economy itself. The destruction is caused by the primal, viral spread of human fear. The most successful investors in history aren't necessarily the ones with the highest IQs. They are simply the people who have learned how to tame their own biological survival instincts. To understand why panic is so damaging, we have to look at the objective historical record of the S&P 500. This index tracks 500 of the largest leading companies in the U.S. economy, acting as the ultimate gauge of corporate health. Its history is filled with moments of intense volatility. In the 1970s, the Middle East oil embargo sent the markets spiraling down nearly 48%. In 1987, Black Monday erased 20% of the market's value in a single trading session. Fast forward, and we see the massive 57% collapse during the 2008 housing crisis, followed by a 34% freefall when the 2020 pandemic forced a global synchronized lockdown. Those events felt catastrophic in the moment. Yet since 1929, the United States has experienced 27 distinct bear markets, and the recovery record for the stock market is exactly 27 for 27, a 100% success rate. Look at this chart comparing the 10 worst single-day drops in the history of the S&P 500 with their subsequent returns. The red bars represent the initial decline, while the green bars show the returns over the next 1 and 3 years. 1 year after 9 of these 10 historically awful days, the S&P 500 posted double-digit positive returns. The data shows the foundation holds. The city always rebuilds. If historical data guarantees a recovery, why do millions of highly intelligent Americans still sell their investments at the absolute worst time? The answer lies in the world of behavioral economics, pioneered by researchers like Daniel Kahneman. He helped define a concept called loss aversion. Human beings are wired to feel the pain of losing money about twice as intensely as we feel the pleasure of gaining it. When a market plunge erases 20% of your hard-earned wealth, your brain processes it as a physical threat to survival, overriding your rational mind. This biological alarm system triggers a flight to cash. In 2025, anxious investors parked nearly $20 trillion in cash investments, desperately trying to find a safe harbor from the market's volatility. This graph shows the re-entry trap. When you sell out of fear, you lock in your losses. By the time the news turns positive and you feel safe to get back in, the market has already surged, buying back in at higher prices. Trading long-term wealth for a fleeting moment of psychological comfort is the fastest way to derail a retirement plan. We can measure the damage caused by this behavior using the QAIB study from the research firm DALBAR, which has tracked investor sales and exchanges for decades. This chart compares the market against the subjective average investor. The smooth upward line shows the growth of the S&P 500. The jagged lower line shows the actual returns of retail investors who flee at the first sign of trouble. Over a 30-year window, the market historically returned roughly 11% annually, while the average equity investor earned significantly less. Because of compound interest, this performance gap destroys hundreds of thousands of dollars over a lifetime. Modern media acts as the vector for this panic. During market turbulence, 24-hour financial news cycles and smartphone notifications fuel information cascades. You see the herd sprinting for the exits, and the compulsion to join them becomes overwhelming. To see how irrational this is, the Federal Reserve tested large language AI models in market crash experiments. The results were clear. The AI agents made much more rational decisions than the human investors. The AI outperformed humans because it lacks an amygdala. It has no biological loss aversion or animal spirits. It simply analyzed the probabilities and stayed the course. proving that the ultimate advantage in investing is the ability to ignore the herd. When the city panics, giant institutional hedge funds aren't the ones paying the highest price. The real victims are retail investors, everyday people acting on sentiment who accidentally liquidate perfectly good assets in a blind panic. Roughly 62% of Americans own stock, mostly through 401ks and IRAs. However, 87% of households making over $100,000 own stock, compared to only 28% of households making under $50,000. Set data shows a deep wealth gap. 66% of white families own stock, with $67,000 median holdings, compared to just 39% of Black and 28% of Hispanic families. Furthermore, white families' average holding exceeds $500,000, proving massive wealth concentration. This matters because wealthy investors often have advisors to act as emotional circuit breakers. But when a working-class investor panics and liquidates a $20,000 retirement account, the damage is permanent. You can build a rational defense. First, zoom out. When the news turns terrifying, look at a 20-year chart of the S&P 500 instead of a 24-hour ticker. The daily fluctuations are noise. The long-term trajectory is the signal. Second, automate and isolate. Set up automatic contributions to your index funds. This removes your emotions and ensures you are buying shares regardless of the news. In a crash, your automatic contributions are buying at a massive discount. Third, curate your media. Financial news networks profit from your fear. When volatility hits, turn off the television and delete the stock ticker from your home screen, so starve the virus of your attention entirely. Fourth, you need to find an emotional circuit breaker. Studies show a fiduciary advisor adds significant value just by standing in the doorway and preventing you from panic selling. If you know you are prone to anxiety, professional management might be your best investment. The next market crash is a mathematical certainty, but while the crowd will always panic, wealth is built by the patient. If this deep dive helped you gain perspective, please like, share, and subscribe to MoneyWise Dollar. We'd love to hear from you. How do you stay disciplined when the market flashes red? Comment below, and see you next time.